All right, what's up, everybody? All right, what's up, everybody? That's a little bit better. All my screens are all messed up because I have a brand new tablet. Got myself a new drawing tablet to write on. Apparently, all the displays renumbered themselves. All right, let me get situated here. What's up? Good morning. Sorry about the delay. Oof.
Vaping nicotine can actually increase feelings of stress and anxiety.
Right.
See for yourself.
Commercial pause. Okay, let's go. Oof. Okay, get started here. Get the new link. What's up, everybody? Photo finish, photo finish. Buzzer. Oh, we got 3 minutes. That's plenty of time. That's like an eternity in streamer land. How much multitasking we gotta do? All right. Yo, what up, Midwest? How you been? Our pre-market stuff going on. Okay, what's up, everybody? All right, looks like our market's pretty rational, pretty nice. Yesterday was a pretty textbook day. Run out the door. I think it's mean reversion didn't do anything. Of course, we break through hedge pressure. Create a bull long up setup. Of course, resilience is positive. Use positive. Everything pointed up. That was the way to go. Hi, yeah. What's up, friends? Love you guys. Really do. Y'all are the best. To get some last minute people message me for some stuff. Okay. Okay. All right, let's get ready to go. What's up? What's up? Benjamin. Wisdom King. Michael. What was it, the cone pattern? So what happens with resilience, right? Resilience is sensitive to half gap. So when it did this, all that meant was that there was a couple of stocks in the Nasdaq and the S&P. Their comments, we found them. It was like Apple and Google or a couple other ones, just at their half gap. When you have big, heavy hitting high market cap stocks trading right here, resilience gets very sensitive. It's designed to be the utmost sensitivity, the highest sensitivity, right in the middle of the half gap. So when it does that, it means some of the big stocks are right on the edge. Of Nvidia, Google, we found a couple of them that did exact. So if they just pass right through here in the middle, it's going to change very rapidly. So they were like chopping at the middle. And so that created that effect. Resilience not just being like your traditional indicators out there have like, they just look at price action and they're just sensitive all the time. That's why they're noisy and they don't really work. So our stuff is designed to operate within a range of price. For instance, like if NVIDIA is just collapsing, resilience isn't going to just fall forever. There's a place where it doesn't even care. And that's the cool part. So it was sensitivity to half cap. And usually when you see it looking like that in both the S&P and NASDAQ, there's something common to both of those indices that created that. And it's usually a heavy big tech stock. All right, stop auto scaling. Let me go ahead and grab my DD band lines really quick. Duplicate. Okay. All right, you guys ready? Let's go. So we got this morning, we are walking into looks like another mean reversion style day. We're actually bear side below hedge pressure. Be careful, watch for hedge pressure breaks on the downside. Let's go ahead and put our DDs probably up here somewhere. Okay, looks like there's no, let me do refresh. Does that make sense? I'll talk about that in a little bit as well. Bear short up scare, liquidity maps open. Bear short up, generally a down-ish sort of thing. High resilient, DD is pretty high on the chart, and this is pretty much a downward-ish kind of pressure if we break through hedge pressure down here. So bear short up looks like this, bear long up looks like that to next resistance. It's going to be wherever we pivot on hedge pressure. And again, actually mean reversion if we're on this side. So this is no setup for SPY. Give me 1 second, wait for Q to come through. Same thing, hedge pressure resistances today. So no long setups today across the board. Interesting how this is working. Okay, give me 1 second, I'll be right back. Sorry, I'm back. All right, let's go. Let's go. Good morning. Good morning. All right. Dude, I'm digging this new playlist on Lo-Fi Geek. Let me start it over. It's kind of a chill. It's called Hello Summer. All right, sorry for the delays today. I had to start the stream over and get everything done. I got myself a new 4K drawing tablet. So I used to draw on, so you guys could see my gorgeous, beautiful handwriting. It was just a 1080p and it was smaller. Let's load this bad boy up. Let's take her for a test spin. This thing's got higher resolution than my regular monitors. They're only 2K. Rez making a comeback. What is Rez making its reunion album or something? Its reunion tour. It's an Eagles joke. Always making their comeback. Hold on, let me put this up. Where's my pencil? I'm gonna draw. Where'd you go? See how well it looks. Hold on. Oh, let me select something here. Oh, it froze. Hold up. What's going on here? All right, and good morning. What's up? Can y'all hear me? Am I loud and clear? Looks like a seek and destroy liquid day. Search and seek and destroy. Oh, my Metallica fans out there. Need some metal references. I'm always gonna be into that. Ooh. That's nice. Ooh, that's beautiful. I like it. That's pretty sexy. All right, let's talk about some trading. Sorry, thanks for being patient with me, guys. Welcome. Good morning. Matt Hetfield. Dude, one of the first things I ever learned how to play was Metallica. All right, mean reversion, long up. Let's talk about this real quick. I'll talk about James Hetfield in a second. All right. Okay, so remember, here's some rules. Let's go through it. Oh, wait, let me get my pencil here. All right, so we open the bottom, you tend to close in the bottom. You open below hedge pressure, you tend to reject hedge pressure. Okay, so right now, we're breaking through it. So I think I need to change the refresh rate of this because I think it's more than 4K, but 60 hertz. That sounds a little off. It should be higher, but either way. Okay. Breaking hedge pressure presses to next resistance. And next resistance, obviously, the mean reversion is there. Because in the middle, DD breaks to the upside. So this is going to be off of the cheat sheet, one of those where it likely goes that the highest. This is the high of the day. Most people are going to sell calls up here. Breaking a bull zone and going is going to be the unusual play of the two, so we're going to be careful there. All right. That's QQQ. It's a good SPY. Similar setup. Yeah, SPY, same exact thing. So obviously in the middle, resilience is going to pivot this. Resilience being negative on SPY. SPY supersedes NASDAQ. SPY is the most important one. We're outside the box. This is resistance. This could be a down day today. Interesting to see that. With a really high DD number, this could be a down day today. An interesting, decently short setup, and we got the yellow lines to bounce between. Still trading between these two things here, stuck in the middle. I would say I'm more likely prone to be on a short side today than the upside. You have sector rotating, so QQQ is breaking up, SPY's picking down, which means healthy and market's not going to crash again. So that's that. VIX is pushing below triple B. Remember, B is always a pivot, so be careful. This is a pivot. If we break through below it, Nice bull month going forward. Now, I'm the person that's called for 500 SPY. You guys know how that works. Back in the day when everybody said the market was going to destroy itself, what did we say here, if you remember? Back in last October, those of you that are brand new to Rocket Scooter, welcome. Make sure you hit that like button really quick. Do me a favor. Give some algorithmic love. We're growing bigger every day. We need to get that algo some love. Why are we not switching to monthly map? Daily chart. Come on. Come on, SPY. Okay, that's a little odd. Maybe a little graphical anomaly here. Let's do this. Let's just kind of jolt it around. See that dislodges it. Monthly map, not auto switching. Oh, let me just click the refresh button. That might change it. Oh, that worked. All right. Volatility's coming back this week. Interesting. Drawings off for a minute. It's like bull side getting stronger, bear side getting weaker. Still same thing. Bull market still goes. Now, in the light of what we're seeing right now, I keep talking about this. Back in the day, if you guys remember last year, last October, right here is when I made that infamous post where I called the bottom right here. Actually, back here, I said that in July, I said that we're going to rally for 2 months. We have a 2-month bear market rally. We called it exactly to the point, literally exactly 2 months it lasted. And then right about here, I said, this is the bottom. I wrote this 20-page thesis on Reddit to talk about why it was. Everyone thought I was crazy and stupid, and they're correct about both of those things, but at least I was right. And so going forward, if you look at what happened, the market's been rallying, and I said we won't get bad until the summer. And then now that the summer's come along, everyone else is finally starting to join the bull bandwagon. Somewhere in here, bears are still trying to short this, and now people are saying, well, how high does it go? Most people are like, well, we're going to double top here, or top here, top here, top here using technicals. And I said in October that we were going to double top the market before we even try to come down. And then as of about right here, while other bears are trying to time when it comes down, I said we're going to 500 SPY. So that's my new prediction. Let's see if I'm right. 500 SPY it is. 500 SPY. There are so many fundamental things that are going to carry this market higher. The market's getting better because the economy's getting better, and that's something you cannot overlook. Where are my glasses cleaner? And we'll talk about that in just a second. Today is a potential short setup day if resilience doesn't give us any kind of stability. Again, I don't short against hedge pressure. I only short against monthly. So I don't really see anything to work around on this one. So let's look at Russell really quick. Let's pop some stocks up on this from the scanner and see what we got. All right, let's go minute mode. Refresh that. Get my drawings there. Scale that. Oh, beautiful. Okay. Oh, turn auto scaling on. That'll help. Turn monthly hedge pressure off. See, here's one of the things. Monthly hedge pressure. We're so far up in bull territory. Monthly hedge pressure being so far down. It's like, okay. Let me turn that off just as an auto scale into it. Yeah, so this is probably a down day today. I don't think we get that upward momentum that we had the other day. Cat really wants me to get out the water bottle. You want me to get out the spray bottle? Where's it at? He's so funny. The rest shouldn't be different. Let's double check what you're saying. Let me go check on that. They look the same. The only reason you see what you're seeing, let me show you this, is because the one on the right updates every 2 seconds. This is like a tick chart, if you think about it, right? Tick charts update every so many orders that go through. This updates every 2 seconds, no matter what. Or actually, maybe not like a tick chart. It's a time chart that updates on a 2-second pulling. It doesn't. You can't change that. So while they're exactly the same, this updates the display on the interval that you choose. If you choose 1 minute, these are 1 minute snapshots. Makes sense, Caddy? They're never different. They're just snapshots. This is the raw feed. A 1 minute chart is going to look different than a 5 minute chart. It's going to look different than a 10 minute chart. So that's what you're seeing. If you put a 5 minute chart, it looks like that. If you put a 5 minute, it looks like that. If you change the duration, the charts are always going to look different. So these are two different durations. But the one on the right is the raw data. I want to see that it's choppy. Like, I don't want to see any kind of like 1 minute snapshots. You're missing all that juice in between these minutes, right? And then this is all the juice. We got it? You didn't notice you could pop out resilience? Oh yeah, you could pop out all these things. Like, let me show you something, guys. Watch this. Let's have some fun here. See, it's a short day today. No, like, really, nobody. Like, I nailed it. I need some cool sound. You know what I'm gonna do? I'm gonna become a real streamer. Like Pinocchio becoming a real boy. I'm becoming a real streamer. I'm gonna get some annoying noises, explosions on the screen, alarms, sirens. Woo woo! Nailed it. You know, like graphics. I just sit here and just talk. Should I become like a Twitch streamer level streamer here? I can give you guys some. Nailed it. Pew pew pew. Let's go. Jump up. Pound my hands on the table. Like a Fortnite player. Let's go. Throw useless shade at other streamers just for drama and likes. It can be like a real streamer. Okay, let's pop out some things. This is how I like to do it. Let me pop out some more. You can pop out everything and just arrange it on the screen here. Just like that. And also make sure you save your layout. So let me show you how that works. Go right here. Y'all don't want sound effects. Like a buzzer, like in basketball. Oh, come on. That sounds fun. You all want to wake up to that, don't you? That's exactly. Bye, bye, bye. You can put some buttons like Kramer. Nailed it. Boom, 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 like a hammer and a nail. Let's go. Okay, ready? All right, that. Make sure you save your layout by clicking this button up here. Save layout. All you click it, it saves. Click the arrow and you can load. That's it. Let's put keys up on the left. Let's put IWM to the right, and let's look for some stocks. Love it. Okay. So today, clearly being a down day, let's go ahead and reformulate where the bottom is. I'm going to put my DD bands somewhere about down here. Across the board, we're getting a little bit of chop. So this is going to be, like I said, there's no real evidence of any upside movement today. Can't say it doesn't break to the upside, but keep an eye out there. Positive DD, all that it means is if you're in the bull zone at support, let me pull out the actually infographics. It's easier for y'all to see that. My favorite things are these infographic sheets that we made. Let's see. We've opened in the middle. Let's go ahead and DD ratio is bullish. You'll know how this works. Let's go ahead and build this up here. I need to add these things to my load up here. Okay. Y'all like these. They're so nice, right? Okay. DD ratio bullish. Check. If you open mean reversion, it breaks the middle tie to the top. Open bear, pulls back down. Hits the top at the highest. If you open bull, bull is support. So look at all those cases here, right? Open bull, bull is support. That doesn't apply. Okay. Open middle, the tie breaks to the upside if it does hit the middle. So open middle, if it hits the middle of the liquidity pocket, which is right about here, and it breaks the tie to the middle. Do y'all see that? So there is no catchphrases. Did I do that? Oh, that one's already been taken. Damn it. Shit. Oh, that's Tim the Toolman Taylor. That one's been taken too. Shit. I need some good catchphrases. You'll help me find some. Okay. Right here in the middle. Y'all, everybody knows, like, I just gave away that I was a poor kid with no cable, and all I ever watched was TGI Friday. TGI Friday on ABC, which I'm sure you all did as well. Watching your Urkel and Family Matters and Full House and Home Improvement. Hey, Home Improvement Halloween episodes were classic. You can't beat the Halloween episodes, they always had some hella good costumes. Step by step. Dinosaurs. So morbid. Okay, look, in the middle, dinosaurs. You know the last episode, dinosaurs? There's a news event of this massive panic. Everything's going on, and basically they kind of were looking at it. It was foreshadowing the asteroid that was impacting the planet. Ooh, what a morbid end to that show. They didn't show them blowing up or anything, but they were like making jokes and cracking jokes in the last episode. And it was foreshadowing impending doom. I was like, whoa, it's a lighthearted family comedy. Now they're all gonna die. Crazy. Okay. Anyways, middle breaks the tide at the top. So none of these apply right now. So essentially, the only DD rule that will apply to the liquidity pocket is if we do trade through the middle, which isn't happening right now. Actually, I need to. Let's go on my platform today. I'm not updating. I have no idea. It's something odd here going on with me. Hang tight. Let me just log. Let me just close everything. I think it disconnected. Let me load my layout really quick. Okay. Something I need to also work on. I don't know if this is just a Windows 11 thing, but it loads my layout, but the Windows sizes aren't the same. I have to do with Windows Aero in the new 11 environment. If anybody else uses Windows 11 and Edge, does it do the same thing when you load your layout? The little spaces in here. Oh, annoying. I always used to turn off those arrow features in 10. Okay, cool. All right, so DD doesn't apply. Resilience, let's talk about that. Resilience being very negative. Very negative. It means in type 1 resilience, outside the box. Let's just draw all the rules here. I need to make this infographic for res for you guys really quick. Get my pencil out here. My handy dandy pencil. Okay. So from middle, positive DD goes to there. Just to break the tie. We open in the middle. Rule at the end of the day, you open in the middle, you tend to close in the middle, open above hedge pressure, you tend to close above hedge pressure. So the market is predispositioned to end up in here, if rational, right? So we're not rational because we broke through hedge pressure. So let's just say that chances of it doing that, I'm not really certain about. But if you think about it like this is a down day, we're breaking hedge pressure. So these alerts are bad. Even though QQQ has tried to break to the upside, it's just healthy sector rotating. So I'm still saying it's a down day today. That's what my call is. Resilience being negative. Type 1 resilience is inside the box. If you hit the middle, it pivots down. If you're outside the box and you hit the box, it also pivots down the next resistance. Okay. So today, resilience DD would supersede resilience. So the chances are, if we do hit the middle, we'll probably have a wave like that. That would have been my opening call. Breaking through hedge, it's just down to DD band if we fall. So if you break through one strike below 435, which is about 434, it's not far from here. It's still in that noise range right now. If you break 434, it's going to be a pretty catastrophic day. So it's probably likely to fall. And of course, easy to see all of that. You don't want to switch to Windows 11. I know you can't move your taskbar around on different screens. That's the one thing I hate about it. Remember, you can just click your taskbar, drag it to any screen you want. Windows 11 got rid of that feature. I don't know why they get rid of features. Bill Gates. Damn it. All right, let's talk about what's going on in the market. Okay, so that's it. Let's look at Qs. And so essentially today is just it's probably a slight down day. Let's see which one is going to be the limiting factor. I think Qs are going to be the highest. Russell's going to be the second, and S&P's the one that's right on the edge of its DD band. So S&P today is going to be our limiting factor. Yeah, Russell below hedge. BLU with the hedge break to the downside. I don't know why it didn't trigger. Oh, that's so weird. Okay. It didn't trigger the alarm because of the one. This is a weird instance. This should have a unless it opened like one tick below. It's like right on exactly the same spot. Exactly the same price. Oh, look at this. Okay. So it opened at hedge pressure and is trading below. So that's why it didn't trigger an alert. Okay, so it opened right on the dot. I thought I had a greater than or equal than sign there for being above hedge pressure to be conservative, but hey, it's not a break yet. It opened on the line. On the line is over the line, I guess. This is like tennis. Gotta switch to primary screen for it. Yeah, you have to switch your primary screen, and then it'll put your taskbar on whatever your primary screen is. But primary screen is what you want, like, things to load up on and everything to be there, your icons to be and such. But you might want your taskbar on another screen as well that's not your primary. Streaming, that's important. Like, your primary screen would be where you'd want to game. If you're a gaming streamer, you don't want to have a taskbar on that screen. You want your taskbar to be elsewhere so you can grab all your apps. I tend to put my taskbar on a secondary screen, as I do now, so that you guys can't see which apps I got open. Who cares about that? Y'all want to see a full screen, beautiful rocket scooter. So they removed that feature because they hate us. But hey, that is what it is. All right, let's see what we got here. The market trying to make a break for it. Let's talk about the end of the day, though. I'm going to be honest with you. This market is not bearish. There's nothing bearish about this market. Everything is bullish. Everything is actually pushing more bullish as the days go by. Analyze the commitment of traders very quick. Everybody, make sure you tap that like button while you're here. Let's just kind of go through a couple things. A little serious opening market talk here. The bulls are getting more bullish. The bears are squeezing. There are 2 rounds of buyers while the dealers are going negative. This market couldn't get any more bullish. It couldn't get any more bullish. This is bullish as bullish can get. Market's going to look for buyers, do everything it can. So in reality, right, there's nothing I can predict from here other than what we see with the DD stuff, right? From the middle, it's going to want to press up and then likely back down to open to stay where it opened. You see how they got some nice little movement here. I think JPal's talking. Let's double check the news really quick in our news aggregator here. I wouldn't take moving at consecutive meetings off the table. So like Fed would skip meetings, so they're not going to do that. There's more restriction coming, driven by the labor market. That's next year. I don't disagree. I said that in the fall they would ramp up rate hikes to make them even stronger, like 1 and 2 and 3, 4 points. That was last year's prediction. So last October, I came through and said by somewhere between December and March, Fed would taper to 0. This is when they were amping up rates. So people thought I was crazy when I said that. Said Fed is going to taper towards 0 and let the market stabilize. People said, no, they're not. It doesn't make any sense. Fed needs a 10 or 12% target. I'm like, I know, but they're going to get there in steps. They're going to raise and then slow down and stay at 0 and sit at 0 until the market stabilizes so that they don't put too much pressure. That's going to go in the reverse direction. And then they did exactly that. Come up to 0 rates now. So, correct. And now I'm pushing my amplified rate acceleration to be next spring or next summer. So what I think now is they're going to sit at 0, let the market stabilize. This bubble that we have as Rocket Scooter's proving and monthly map is showing, we're going to continue to inflate up until October, and they're going to start raising rates again probably about September, October, 25 points, 50 points, and then by spring or summer, they're going to be going 1, 2, 3 points a pop. We're going to end up at a funds rate at about 12 to 15 by the end of this, I would say. They have to do this to put the nail in the coffin. But here's the thing. The market's going to be so healthy and stable, it's not going to care. It's not going to interrupt the bull market. If you go look at the SPX chart from like 1982, 1984, we saw rate hikes in the middle of a rally. Same thing. Market's going to be so bullish it won't care. Those big rate hikes are going to dip the market really quick, and people can't wait to get in and long. That's the environment we're in right now, and I'm sure hopefully I've presented a good enough case to everybody on this team. Not that I try to sway, I can't sway anybody's investment decision, tell you where to invest in. I tell you to read the market. So here's how we're going to read the market, right? I mean, there's nothing bearish. This is the most bullish setup you can get. Everybody's buying. Asset managers are getting more long. Leveraged funds are getting squeezed out of their shorts. The dealers immediately went short. One of two safety nets is gone. When the dealers are net positive on the commitment of traders, the market's never crashed. So one safety net is gone, but it doesn't mean that's a bad sign, because when the green and blue are both pointing up, the market's illiquid to the upside. When the green and blue pinch or pull from each other, the market's becoming more liquid and buyers and sellers are finding each other. It's a little bit more of a stable environment. Like an example is here, green fanned out, blue pinched in, green pinched in. So that's a more stable environment. When they're both fanning out, that's illiquid, so pressure's building up and the illiquidity popped the market. I'm sorry. Fewer traders. Sorry. More traders. Listen to what I said. When they're both fanning out, the market is insanely liquid. Tighter market. So more people longing against more people shorting. That tightened up the market. We have more participants. Everybody putting pressure. It's like a spring compressing. That DD was well over half this entire time. So everybody trying to short here got squeezed out, and we made a fucking killing longing this thing from the breakout. And right here, the breakout squeezed the shorts. Can you see who lost the fight? This is how Rocket Scooter predicted these things. You see who lost the fight, everybody. Shorts shorting against the market, longs longing against the market, and the market compressed. Who got out of their trades? Everyone type it. Who got out of their trades? Who lost the fight? COT's updated once a week. The shorts got squeezed out. Isn't that what monthly maps is designed to show you? Longs are getting more long. Shorts are getting squeezed out. Didn't I make a video the other day that said SPY 500, and the entire video was talking about a parabolic squeeze because shorts are getting squeezed out? Isn't that awesome? Isn't that awesome? Isn't that awesome? That was my video from 2 weeks ago. You like to watch it. This is before I said the shorts are going to get squeezed out. The video aptly is called "The Recession Might Be Over." That was the video. You guys want to watch that? This is before. I said, Rocket Scooter saying it's going to be the shorts that get squeezed out, because that's exactly how monthly maps work. And we won this. We literally, and then now the momentum is going to pick up. Look at this. Two things to take away from monthly maps. All you do, this monthly map is literally the best thing for anybody that's not day trading. Anything that you're looking at, at least 2, 3, 4 days into the future or longer, monthly map is the best thing we have for that. Let me show you how it works. Monthly map uses options to predict a risk landscape over time. This is the bull zone at the top, bear zone at the bottom. And if you see, the bull zone is having a lower floor. Oops. Getting used to drawing on a tablet again. You see this? If price were to stay the same, you can see how there's more bulls and more bulls and more bulls as time goes by at the same price. Do we see that? So far, so good? So at this price, there are bulls willing to be bulls at a lower spot. If today the market fell to 420, it would be in a bear zone, and it would be bearish for all about 3 or 4 days, and then it would be neither, and then about a week later or 2 weeks later, it would be bullish again. So the market fell to 420, it means within a 2-week period, there are bulls waiting to buy the dip there. So meaning that if you're falling into prices anywhere, and as time goes by, there's more bulls at a lower price, then the bulls are becoming more long the market. As calls go in the money, it forces the call sellers to actually long the stock. Do you understand that so far, SP? So what the thing is that when the bottom of the bull side, just the bottom, is sloping lower, it means that bulls that are long, getting more long at a lower price. So far, so good? Okay. And the commitment traders show that, right? The asset managers, the longs are becoming more long. our options analysis reflects exactly what we've seen. Did you know a monthly map has had this bulls become more bullish pattern since last October? When the market started pivoting lower and I started pitching this idea to Ashton, hey, I got this thing called monthly maps. They're going to release it in December, January. And I was showing it to him and I was like, in October, I was like, look, this thing is showing that the market's bottoming out. There's actually bulls stepping in. He's like, whoa, that's cool. Well, let's see if it plays out. And I was like, yeah, I made a post calling the bottom. People think I'm crazy. And then the bulls started stepping in. And then the longs are becoming longer, which is exactly what I'm saying. Bulls are becoming more long. Pretty neat, right? Okay, so the same thing is here. As the bears require a shorter price to be bearish, you can see that people with puts are just falling off the table as the weeks go by. And not only that, they're deteriorating at a rapid pace. Look at the slope difference. Look at this. Bears are completely getting squeezed. So bears closing shorts rapidly. Yeah, yeah, right. We're beating the commitment traders and predicting what that's going to say. That's exactly what this has been showing us again since last October. Not only that, the market is for like 2 weeks not volatile. Volatility is a space between bulls and bears where bulls and bears disagree with each other. There's no volatility for the next couple of weeks. Look what we're predicting. The VIX is in decay. Do you see how monthly maps gets ahead of everything? People's positions show you everything. We're showing bulls getting longer. Check. Bears getting squeezed. Look, we said that for months, and then boom, they got squeezed. We won. You go back on my Twitter feed, I've been posting the bears are about to get squeezed. I've been saying it for months, and then it just happened. Look at this. That space between the bull and bear zone, it's not even there. The market's not even volatile until the 7th of July, and then the following week we get some volatility. So VIX is in decay. We're proving that. Literally, monthly maps tells you everything about the market before it happens. This is the biggest thing we have. Ashton loved this so much. He's like, I want in on this. He goes, this is by far the most inventive thing I've ever seen in my entire life regards to stock market. It's like this one tool shows you everything. And Ashton and my company joined forces because of monthly maps. And I said, just watch it all play out just like this. People's positions tell you the world. So here, what's happening this week that makes it more volatile, right? Something's happening in the first week of July. So there's probably got Fed meetings and stuff coming up. Come through here, the market's telling you we're going to have some waves of volatility in here and in here. So let's see what's coming on, next week. July, do we have anything? PMIs. Yeah, we got some pretty decent heavy news weeks coming through. Non-farm that week, so you got payrolls, PMIs. It's a pretty heavy week. I can expect some volatility that week, right? So even telling you people are positioning for that volatility that's coming up, and I'm sure we got a Fed week after that. The map maker, matchmaker, there you go. Okay, so anyways, this is still showing a perpetual short squeeze. That you can see that the shape of the bear side is changing a little bit. So we're still squeezing very rapidly and parabolically through the end of July. Bulls are going to take some profit and sell off. But in general, bulls are willing to buy the dip through September at a lower price. We can see that. Sorry, October. Bears start to put on some more bear pressure. So essentially the bears that are getting squeezed through July are going to start shorting again right about the end of July. So they're going to get squeezed for about a month, and then they're going to start shorting again. So let's just predict the commitment of traders like we were doing earlier. And I love doing this. I'm predicting where the flow of people's positions are based on the forced hand buying and selling of options. God, I love doing these things. As much as I joke around, come on, y'all gotta know that I'm pretty damn good at this. We've been doing this for a while, so watch this. Ready? Let's predict the commitment of traders. Let's get months ahead on this bad boy. All right. So like I said, the bear. Oops. Let's give you some space here to look at this. All right, let's do it. Let's draw what it's gonna look like. Sound good to me? All right. The blue line, cool. All right, so. Bears are going to get squeezed through July, so that's about maybe 4 more data points. And then they're going to start shorting again I can't see because of that damn axis. Let's just draw it with like a different color. Let's use a black. That'll be easier to see. All right. So you're gonna get more squeezing on the short side, and they're gonna pile on the short again. It's gonna look just like that, another wave. So bears are getting squeezed, and they're gonna short some more. Now the magnitude hard to guess, but you can see it's gonna look like that. Bulls are getting longer and longer and longer and longer, and then selling longer and longer, and then selling. 2 waves of bull. So wave of bull is gonna go until July, and then selling. At the same time, the inflection point. And then it's going to be long, 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 long until October. Maybe not that amount. October. So this black line down here, I didn't draw it all the way to scale, but let's draw it to scale. Let's make it a little better. Exactly what's going to happen. You're going to have bulls. You're going to buy, and then sell. Buy, sell, buy, sell, buy. So this green line is not coming down. Markets do not crash as long as there are people willing to buy at a lower price. There is no crash. Zero crash scenario at all whatsoever. The recession is over. We've escaped it. The tech rally pulled us out. The improving GDP, the improving employment numbers. We slightly missed a market crash. Powell drove us out perfectly. No recession. The stock market is so bullish that there is very little chance of companies going bankrupt with their stock prices doing well. They've already laid off the fat and stocks are going up. That's the ideal situation for a company. Trim your fat and still increase your productivity. Can't get any better than that. That's the whole title of the video. We've escaped the recession. We got pretty close, and Powell's convincing of the stock market we're bullish, and this big tech bubble is pulling us out. We got lucky that a bubble started forming to save the stock market, to prevent hundreds of thousands of layoffs, which those people don't go out and spend money and slow the economy down when they don't. And then we lost all that. So here we go. Shorts are squeezing still. So longs are buying, shorts are squeezing. Then at the same time, they tend to pinch together. So more shorts when there's less bulls. So okay. Bulls are becoming more bullish. Shorts are becoming more short. So like this. And at the same time, they fan out. So basically, you have a period of illiquidity where they both point up. When they both point up, it is a fast move through July. Fast move through July. Literally a fast move through July. It's going to go fast as shit if it moves. And then it becomes liquid again, which means the fast move is going to right about here. It's also going to be volatile. You're going to have some selling pressure in there. Like that. Because you have people shorting and people longing. Back through here. It's going to tighten up again. One final squeeze. And we're out. You'll see that? Pretty cool, right? So down here, once those shorts start to pick up again, as soon as the bulls start selling, which we have no evidence of. Actually, let me start over. No down. Sorry. No down. I'm so stupid. Some volatility. And then there. And I don't know why I drew down, but we don't know. We don't know what's going to happen there. 500 spot. It's very clear to see that. Little period of volatility right in here. Little period of volatility right through here. What do you guys think about it now? What's the difference between the two? You see the market is just too liquid to crash, and it's kind of easy to see that. Okay. The difference between the reports, so different reports mean different things. So you'll have like the classic TLC. Can you apply this to shorter time frames daily? Yeah. I'll show you, David. Hold on. Well, this is looking at the history of. Yeah, you want to look at shorter time frames. Just zoom in right here. Same analysis, right? You want to look a couple days out, right here. Look, you have 0 days on SPY and QQQ make it pretty easy. SPY becoming more bullish, stabilizing. Bears getting squeezed, shorting again. So up. Consolidate. So this is like gonna hold this 440 level. That's exactly what that shows you. F main Zane, thanks for that's happening. Awesome, man. Awesome. Okay. Hourly. These are looking at expirations on options. There are no hourly expirations on options, David. The highest resolution you have is a day that an option expires. There's no way to physically do this for something on an hourly chart. This isn't technical analysis. Yeah, Cotton said, at least not yet. Yeah, the CBO, the CBO loves making money, so they'll probably make options that expire at 1 o'clock, 2 o'clock, 4 o'clock. Then hell yeah, we'll have hourly maps, baby. That'd be great. Well, the casino loves putting in, giving gamblers more granularity. That's for sure. You got your $1,000 high rollers table, your $100 table, your $20 table, your $1 table, your 5-cent table. They're gonna throw in a bunch of tables at the casino to cater all kind of players. That's for sure. But let me show you this. So what's really cool is we have actually daily mode, which will tell you what's happening today. So you click daily mode on Rocket Scooter. Like I said, everybody check the link below, and pull this out. Positional risk analysis. This is why our whole group is just like, we're so excited to present this to you all. Our first year, we just approached our first year anniversary. We have 4,300 user accounts. That's completely blown my mind. I thought we'd have 1,000. We're somewhat going viral, and this is making me very happy to see that this type of analysis is some people really want to overcome or offset the problems they face with traditional analysis, like technical analysis and things like that. Okay. Okay, so let me show you how to read it right now. So everybody do me a favor. Go to the link below, grab the extended trial if you want to check it out. And you can play with everything for $35 a month for the $200 a month package. So the way that this works right here is I'll show you. So the longer term monthly map forecasts the pivots in the market up to 3 months in advance, which is what our technology does. It's showing you where actual options positions are held by market makers who purchase them from options dealers, and that we extract just that information from all the residual stuff, which would be speculative, things that don't fall inside the hedging model that we created. And then we can cleanly draw a bull and bear zone for anything, any stock, any index. See how there's a clean bull zone and a clean bear zone? That's from our algorithm. And so inside of the daily mode, you click daily, and it just combines all that risk into one mode. And each of those options is balanced for today. So if you were to trade this today, you are trading in a bull zone here and a bear zone there. This is like compressing that slinky all into one day. There's a little bit extra math though, because you can't just sum everything up. There's a bunch of Greeks that have a magnitude of a magnitude difference based on the difference in when they expire in today. Okay, so here is a beautiful hedge pressure break. Okay, so let me show you. Let On the daily mode, what you do is you'll come up here. Let's look at QQQ for an example, right? Different one. Actually, let's look at like, oops, why did I say BLU? Let's look at like Apple. Let's put a stock up here, right? Apple, when I run it the mode daily, Apple says BLU. And so what you do from here is we give you some infographics, a little reminder, liquidity map is one of them. Liquidity map is a little guideline that'll tell you if the letters say BLU, let me find the BLU. And this is going to tell me that we're long gamma on weekly options, which is the blue. If you break through the blue, there's pressure to the yellow. If you open above the blue, there's support at the blue and back to the open. Turn out that commercial here. And if you trade above the open, then it moves to next resistance. So let's put all that together. Like I said, we encourage everybody to check it out. It's $35 a month for the $200 a month package for 3 months. You can be in the extended trial for 3 months and literally go through and learn this whole program, learn this whole process of analyzing the market. And I mean, you can't really beat that price. I know people out there sell monthly indicator packages for $1,000 a month and stuff. $35 a month, you can learn a whole new style. This is a big deal for us, and we're excited to have y'all. Okay, give me 1 second. I have a important email I got to. Okay, so in BLU, let's draw what we see, right? You can see that right here. I take the letters and I match all the pressures. B means we're in a bull zone. Check, this is a bull zone. Long means we've got positive gamma on weeklies. And then up means weekly hedge pressure is greater than monthly hedge pressure, which you can't see because it's way off the screen. Okay, so you have two different gamma positive. You have gamma positive on weeklies and gamma positive on monthlies. I have monthlies turned off just because they're so far away. So BLU pressure is generically up, and if you break through here, it's a weekly gamma squeeze down to monthly hedge pressure. That's if you break. But other than that, if you open above and it starts to fall, there is that long gamma pressure brings you back up to open. Look at this. The open price is here on Apple. Open. If you fall, there's that long gamma brings it back up to open. That's how it works. You see it? David? Is that pretty cool? All we're doing is balancing the forced hand buying and selling of gamma and delta hedging against the bull and bear pressure of the actual underlying positions in the stock. So we're comparing the options and stocks together and creating pressures. If you support at the open, it trades to next resistance, which is that leg, which we have to find where that is, maybe a gap fill or something else. So that's what we're using, is just positions and delta hedging to create moves in the market. And this is a universal thing. As long as there's something that has options, it's going to be hedged against it. So basically the thing we're exploiting is this. You go out there and buy 1 million shares of Apple with a market order because you're a big baller like that. So you were a trader who bought 1 million shares of Apple. And there's not a trader on the other side of that sitting there on the ask. You have a market maker of the stock who shorted 1 million shares to you. They don't want to be short in that clear bullish moves, they're going to buy calls. And they're going to weigh those calls by the delta, by the amount of calls they need to match the risk they have. You're going to have a market maker and options dealer, the one who sold those options to them. Actually, let's just say that they just buy the call straight up and don't even hedge. These guys sell the calls, and now they're going to balance their risk according to the delta. If those calls were right here, and you go into the money, delta's 5 and delta 6, delta 7, then they're going to be buying 60 shares per option, 70 shares per option, 80 shares. The insurance salesmen are forced to buy as the option goes in the money, and then forced to sell minus 10 each time you lose 10 delta, etc. So if those options go out of the money, then the option seller becomes the seller of the stock, and you are the buyer of the stock. The market maker has found a buyer for the seller. So the idea is that this person's trying to match the order and have no risk in the middle. So what we do is we look for these delta weighted calls against a large position of that guy, and we find a bull zone. If these calls exist, then that trader is in a long position against the house where there was no seller, an illiquid buyer. That's what makes a bull zone. Check. Number one, a buyer with no seller, and the seller has to be an options seller to a dealer who's forced hand to buy or sell the stock underneath it. So that's how we identify bull zones and bear zones. Delta hedging from those market maker of options who sold the calls weighed by delta. So they're, when I say that, means they're delta hedging. If the calls are exactly here, I'm going to make up a number. If those calls are in the money, and this is the only trader there is, then this person has to long. They have an obligation. If say that the answer was just 100 shares, okay? And this person sold one call, and those calls are in the money. Their obligation is 100 shares. If they had 0 shares, they got to go out and buy 100. Now, chances are they're going to weigh by delta, which is okay, but every time delta goes up 0.01, they're going to long 1 share, which pushes up a little bit more, which makes them long 2 shares, which pushes up a little more, which makes them long 3 shares and 4 shares and 5 shares, all the way up to 100 shares. The obligation of them going from wherever they are delta hedged to full obligation, because these options can be expired at any point in time, pressurizes the market, and the dealer who sets the price of the underlying is the one engaged in that trade with them. So they're going to raise the price knowing that they need 100 shares to force them into that trade. And that's how the dealer of the shares force option sellers to be the buyer or seller to the trader in the underlying. So they whip them all the way around like that and raise the price because they know that these folks are in options trades against them, and they know they have to long that. If they need to find buyers, they bought calls from a bunch of call sellers that are clearly in the money from these bulls. So they're going to keep raising the price to force the call sellers to accumulate the stock. That's what hedge pressure is. So hedge pressure is the net gamma maximum of just options sold to dealers from other dealers. Gamma, first derivative. I'm sorry. Del delta, del price. Sorry, fixed time. Right? Second derivative, change of price of the option. This is change of price on underlying. I think that's how the math goes. So delta is, actually I didn't draw the equation right, but delta is change in price of option. So it's del that is to del that. Right. So we do this math and we find that balance, and all it says here above hedge pressure, the gamma of that relationship of that market maker triad is positive. So if everyone would take their hands off the market, the buying would have a what the L stands for is that gamma is going to be more long than short. So you're going to just have a general push like that as option sellers are squeezing option sellers into the price. If you're below hedge pressure, it pushes that way. Do you see how there's kind of like this kind of like pressure floating it up? That's revealing that market maker delta hedging to you. And that's what this does. Powell says there's a significant probability we get a recession. I don't know what his definition of recession is. This is what I don't like. I define recession by two things. I define recession this way as a trader. Okay, ready? Here's a recession. GDP is going down because unemployment is going up. That's my definition of recession. You can't get any more simple than that. People are getting laid off and it's lowering productivity. That's what caused a recession. And I say we're leaving a recession when productivity, GDP goes up, when unemployment's going down. You don't get any more, like, to me, you don't get more clear than that, right? That's pretty much the most basic definition of a recession. So if I'm working, I get a wage and I make something. My wage goes out there and buys someone else's make something. And their wage goes out and buys someone else's make something. And their wage, well, they bought my make something, right? I make something, someone else needs to buy it. I got paid to make something, I bought something else someone made and got a wage. As long as this circle is moving faster, the economy is getting better and you're out of recession. If that circle is slowing down, the amount of time it takes for somebody to save up enough money to buy someone else's make something, that circle is slowing down or hits logistical hurdles or goes to the next step, like in COVID, logistical hurdle, it's got speed bumps along the way, or it's slowing down, and that's a recession. So if you were to chart what a recession is the speed at which you draw those circles. Ready? I'm gonna draw it for you. Ready? Improving economy. Improving economy. Improving economy. Improving economy. Stable. 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 Bubble. 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 Pop. Recession. Recession. Exiting recession. Steady growth. You got it? The cycling of commerce creates economic growth. GDP means people are making more stuff. And unemployment means more people are making more wages. Does that make sense? Questions? It's all advanced TA right there. So that's basically it. It's like a tornado. So the idea is that when Powell says he thinks a recession is coming through, then he's got to be talking about one of two things in that equation. Either A, GDP is going to be coming down, or unemployment is going up. Fewer people means fewer wages to buy something, and possibly fewer make somethings, because if that person actually made something. Well, right now, what we went through was a bunch of layoffs that laid off the people that didn't make something. People were getting wages, right? But they got paid to like watch Netflix and Zoom. You guys remember when you have like your dating apps and it was like, yo, baby, let's Netflix and chill? Well, a lot of people got paid like ridiculously high wages, like 2 or 3 times in recession, so they can Netflix and Zoom. And they really didn't do shit for a job. That could have been a lot of you as well. Y'all caused the problem. Actually, we all caused the problem. Just making fun. But that Netflix and Zoom was really, people had all this money. They didn't make anything. And were you surprised that there were shortages, right? We sold out of everything. People had so much money to spend, they bought it all up. But then nobody was making anything after COVID as well. We had shortages after COVID because of logistical problems. And then we created a shortage environment, right? where prices of things went way up and the wages had to go up to reflect that. And then that high wage got built into the cost of production, and then the price of goods went up, and therefore that's why CPI went up, and that's what caused the inflation. Shortages, people with more money to match the price when you had your demand outweigh your supply, and then of course prices went up to reflect the shortage, and then therefore people demanded higher wages to buy the expensive houses and stuff. But all that time they weren't making anything, so GDP was kind of coming down, right? The market was hitting bottlenecks. You're not going to keep producing stuff if the warehouses are full, and the shortages because there's not a truck driver to move them to the store, right? So you slow down production, lay everybody off during COVID, and then slowly start to grow back. Produce as fast as you can so your wholesalers buying from you, and then you hit this logistical bottleneck. So like that cycle was like bottleneck, bottleneck, bottleneck. It wasn't really spinning. You'd hit a hurdle. Well, this truck driver needs a tire. Well, this tire needs to come from a boat, and that boat's in China. That boat can't leave China. It needs gas or needs number 6 fuel oil. Why? Because the boat with the fuel oil needs repairs. Why can't it come? Because the repairs come from a part that's on a truck. Well, where's the truck? Well, the truck is still sitting there from the last shipment. He needs to unload those things before he can get on and do the next shipment to repair the boat to bring it. So, right? So that's what we had. And that stuff cleared up once everybody goes back to work. Jay Powell driving the boat. Stock market started plunging. They had to stop raising rates to save the banking sector. We know that. They didn't let the market stabilize. As the labor market starts to come down, we had 4 waves of layoffs, 2, 3, 4. And then waves 3 and 4 created a thing where continual jobless claims grew up. So essentially in the first 2 waves, people got fired and got their jobs back. Fired, got their jobs back. But in this area where people were getting fired and not getting their jobs back, then you had people desperate for employment. So you had fewer jobs. And at this point, the jolts came down. There were fewer jobs. And a lot of people needed jobs. So therefore, that internal competition between the labor market, people that need a job versus the available jobs, drive wages down. And therefore, if, like I said, if there's infinite jobs and you're the only worker, you can demand whatever wage you want. That's what happened in COVID. The first truck driver, balls of steel to want to get back out there in this crazy world during COVID to work, says, oh, there's 10 of you that need a driver and I'm the only one. Well, you will pay me twice as much for my normal salary because I'm the only one. And you will pay it because you need me. And then people go, fine, whatever, here's your money. Right? That's what drove wages up. Now there's one needed truck driver and there's 15 of them waiting for the job. Wages came down and therefore CPI came down. That's where we are. CPI came down on its own. Powell didn't need to really do much to keep the stock market from crashing and then keep the bond market from collapsing as well. That's all they needed to do. It's just float things a little bit and let the logistical thing heal itself. Let companies, they literally rose rates to put pressure on the stock market to force companies to lay off the fat of the Netflix and Zoomers, which they did. And as soon as they did, inflation started coming down. How about that? Because smart economists like myself understand the mechanism inflation had everything to do with wages. So all they had to do was essentially threaten the stock market with QT and rate hikes to allow people to dump stocks, and stock markets are falling so that shareholders pressure the board and pressure CEO to lay people off, which they did. Then that came back into the efficiency. You know, people essentially, they laid off people who weren't making anything, so the cost per labor actually drove up the production per dollar spent on labor because you're not wasting money on Netflix and Zoom. And now companies became more efficient. That manifests itself into the next quarter earnings, where margins went up. Every single earnings report this last quarter was a massive beat with great forward guidance. Well, that's what happens when you lay off Netflix and Zoom. You improve the bottom line of every company that does that, and therefore you can actually lower wages because now you have a lot of people to hire from. Great, talented folks, they need a job, and now you as the employer can charge lower wages. It means you can produce things cheaper, which means the cost of production comes down, and therefore the final cost of goods come down, which relieves folks from the stress they have of buying things. Things are less expensive, so people tend to spend a little bit more money, be less money conscious, especially if they're getting their jobs back too. And that brought us out of the recession. So now what you have is GDP going up. So every dollar spent on labor, is that directly converting to more production per dollar spent on labor? And if that's the case, GDP expected to go up. And I heard the other day that Goldman Sachs raised their GDP estimate by 10 basis points. That's all you need to know. Which means that people are actually producing more goods than the cost it costs to have them employed there, which is great. That's all that it means. So right now we're staring at is unemployed folks don't really spend money the longer they're unemployed. Like if you're unemployed for 1 month, if you were saying how much you spend per month of unemployed, you pretty much don't act like you got fired like right out the door. Then after a month, maybe you're the same. Then after 2 months, you're like, oh yeah, I need to save. I'm kind of fucked. I'm like 3 months past due on my mortgage, blah, blah, blah. So people after like 2 or 3 months of being unemployed tend to spend a lot less. So therefore, that cycle slows down after they get laid off. And therefore, demand for products go down. So your shelves, back up and you're full. And then they stop ordering, from their distributors, which stop wholesale buying from producers, which slow down the economy, etc. So the longer people are laid off, the chances of recession go up, and staying in recession goes up as well. If you have a recession with inflation, that's called stagflation, which is really bad. So right now we do have the unemployment situation, but lucky for us, the CPI is coming down. And that was an easy fix because all you had to do was lay some people off. So no stagflation, so we're good there. We're not going to have soup kitchen for 10 years recession like in the 20s or the 30s. So we're kind of just sitting pretty, and Powell has no reason to do anything except for wait it out. So we're good. So if GDP goes up, which means that for the same amount of people working, the same amount of dollars invested, people are increasing productivity due to whatever. AI is increasing efficiency. People are working harder instead of slacking off because they don't want to lose their job, or companies just reinvested in efficiency from the money they saved laying off the Zoomers. Then all of a sudden, efficiency goes up and GDP will go up because you're producing more from all that efficiency, and that's fine. And as long as unemployment comes down at the same time, it means everybody going back to work is making something for cheaper. Therefore, you can make more of that for the labor spent. Therefore, that circle starts to speed up, and we left a recession. That's how it works. It's all you need to do. This is just basic relationships of supply and demand and labor. This is nothing rocket science here. This is like your first 3 pages of an economics textbook. Let's look at that data, and then we're going to get out of here. Nice little bull market here. I didn't make any trades today, not do anything. Let's go here. Let me pull these data points up. Initial jobless claims. And I'll show you the data. So continuing jobless claims. Initial jobless claims. Jolts. All right, there we go. Final. GDP. Okay. So, as you see, the forecast of the GDP is improving. Right? We got bad. This is a quarter over quarter change. So okay, let's think about it. This is not just raw GDP, it's quarter over quarter. So the quarter over quarter change. Let's see if I can. Sorry, hold on. Let me see if I get one more thing. right-hand side. Okay, there. So you can see like quarter over quarter, the GDP was rising and coming down just in a couple waves. Typically, you want to see just GDP growth, right? Anytime this number is above 0, your economy is growing over the course of the quarter. So as you see, it was threatening with less growth. It doesn't mean it was shrinking. It's still been doing good. You see these numbers right here. The quarter over quarter increase is better. As long as this number is above 0, then the growth rate is positive. If the number is below 0, then the growth rate is negative. You're shrinking from quarter to quarter. This threatened coming close to 0 growth, and the forecast just picked up quarter over quarter growth. That's great. So check, number 1. GDP is expected to stay positive. Quarter over quarter growth, that's GDP up. The growth rate is positive. Jolts here. Let's go to Jolts. Just keep this number in your head. The number of available job openings that in a 30-day window are trying to be filled. The position exists and there's active recruiting for it. Jolts have been coming down since May of last year as companies were laying people off and not really hiring back. But now we're on a hiring spree. Jolts have gone up as of May of this last month, a month ago. And the jolts came in massive, huge job openings. There's a tech boom. People are getting back to work. So if the jolts coming out on the 6th of July show another sign of growth, not only do you have more people working, which means more people with salaries, which means more people investing in their 401ks and more people spending money on other people's make somethings, then all of a sudden you have more job openings available while GDP is rising. That is economic growth. Economics 101. You're hiring people because you're producing more stuff because the demand for your product is there. People are buying the stuff you're making. You don't do that in a recession. Jobless claims. Last couple of things. Initial jobless claims are layoffs. You get laid off, you go sit in your car, you fill out the form to get your unemployment. That first week, these are your first week filings. Shit, I got laid off. I got to continue. I get my unemployment check. So you have 4 waves. People got, this is week over week layoffs. They went up and then they were still high and they started coming down. So people are like basically getting laid off in droves across the board in all cases, right? And then basically people are getting laid off. And now we have consistent amounts of layoffs, right? So people are consistently getting laid off week over week and at a higher rate. That's kind of the scary part. That's the one part that still leads to possible recession. As you keep seeing the words that Jay Powell himself is saying, the only damning sign of this entire equation is that labor market. And again, if we go down to, let's just see right here. Jay Powell was saying stuff earlier. Wasn't there some red text? I wouldn't take blah, 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 executive meetings. I believe there's more recession coming driven by the labor market. Isn't that crazy? How you know exactly what they're looking at because that's the only scary thing that's still left. Mr. Powell himself is also looking at the same thing Daddy Matt's looking at. The labor market. Yeah, you're continuing to lay people off, but let's look at this. The continuing jobless claims are telling a slightly better story as the people who were laid off and still qualifying for unemployment has been coming down since April of this year. So while companies are still maybe trimming the fat or feeling that final burden of needing to lay folks off, as you see, the bulk of it is that people are actually returning to work week after week. While more people are getting laid off week over week, more of the people that have been laid off are getting cycled back into the workforce within a 1-year period. So the people that are getting laid off today aren't going to feel the stress of that layoff for about 2 or 3 months. You ever been laid off? I was in 2010. My engineering job. I probably still lived like a king for a couple months. I didn't start to feel the burn until bills are past due. People tend to have savings for the most part. So you don't want to initially just immediately start acting like it. Most people are more confident in themselves. They believe they're worth more than they actually are. It's called Dunning-Kruger effect or something, right? People believe I'm gonna get my job back. Something amazing. And they're gonna hire me back. So they tend to value themselves more and they don't spend like they're laid off. And so usually see 2 or 3 months of cycling, then that's it. So right now, the people that are just now getting laid off aren't going to start affecting the economy until 2 or 3 months out. And hopefully they get their job back before then. And with the jolts growing, hell, that's a great opportunity and chance that people are going to be able to get a job back with more jobs available. It's already showing that right now as the unemployment's coming down. The jolts are pulling people that have been laid off for at least 3 months. See, those 4 waves earlier of the initial claims went up, came down, went up, came down. When this number comes down, it means those layoffs of the initial got their jobs back. So now these 2 last waves, they're not getting their jobs back fast enough. Some of them are, but now there's a trend of them getting their jobs back. As the economy is starting to fill this pool of unemployed workers with more people, as you see, more people week over week are getting fired. The net sum of people fired is returning to work. So the turnover of unemployment is very rapid. So hopefully people go back to work before that 3 or 4 months and their bills are behind. And when their bills are behind and they're not paying their bills on time, then banks start to rate credit at that tier as risky. So they stop lending money out, which speeds that circle up as people live on credit. As long as people are going back to work faster than they're going to be stressed on their bills, then banks are not going to change their risk models for issuing credit, and credit's not going to dry up. As long as credit's not drying up, then people are going to be fine. And as long as this number's coming down, that means people are like all their buddies. He got laid off, but he got a job back in 2 or 3 months. Oh, fine. Ted just got laid off this week. Oh, how sad. Well, it's okay. Billy got his job back like in 3 months. So Ted should get a job in no time. And people aren't feeling that burn. And so right now, this is all the recipe for exiting recession. This is the whole point of that video. GDP rate is still growing positive. Available jobs that need to be filled in a 30-day window. People that are unemployed for long periods of time are getting their jobs back. Despite waves of layoffs, the economy is so resilient, it can handle waves of layoffs and still grow. It means efficiency is getting better inside of the companies. And probably they took all this money they saved firing people and invested in their own efficiency, which means the efficiency per dollar of labor is going way up because you can produce more with less people. And you produce so much, there was a boom for your product, you started hiring people back. So companies dug themselves out of recession. Yay, we did it. Go world. Everyone pat yourselves on the back. You did it. You did it. And only thing Jay Powell's worried about is the labor market, because the only thing that shows slight possible issue is that we're still laying people off. So those are people that aren't getting a wage to buy someone else's make something. And how do you know that I'm right? Because Jay Powell said the exact same thing. Wouldn't take recession off the table. We're keeping our eye on the job market. Well, he's just looking at the current chart. But do you see how you as a trader can put that all together yourself? And that's how you do it. He's not saying anything else, right? There's a strong majority for 2 more rate hikes. Blah, blah, blah. I think there's more rate hikes than that coming. In the dot plot is each member's opinion of what they think is going to happen. There's a couple of members that believe rate hikes are coming. I think that's coming next year as well. See more tightening power coming through. That's clearly their initiative. See, not really a lot of information, but they know that the labor market is the problem. If people still are getting fired, and if jolts come down, then that throws my whole theory out the water. Companies are creating jobs, and my theory is that this tech boom, this AI boom, is stimulating that tech environment where that is where people are getting their jobs back. Healthcare stayed strong, utilities stayed strong, oil and gas stayed strong, tech got reamed last year. Google's and Microsoft's, everybody's laying people off in droves. Now they're starting to hire people back. I believe that the tech bubble was the icing on the cake that saved us from a recession. Damn it, Smithers. This isn't rocket science. This is rocket... Damn it, Smithers. Interesting theory, but it sounds like the Phillips curve. I don't know what the Phillips curve is. What's the question? What's up? Gyokan, what is your question? If you sell, do I need to wait for the market to buy my stock? I don't understand what your question is. I don't want to answer it. No offense. But puts credit. But did it put credit spread off that gamma squeeze? Took about 15 points FPX. Yo, what's up? That's how you do it. Okay, so honestly, this is what I like to call street economics. I don't have a degree in economics. I have a degree in badassery and chemical engineering, but mostly badassery. I learned this by I love to do crosswords. I do a crossword every night with Nicole. It's one of our favorite things to do. Take a gummy and do a crossword while high and see if we can beat our last time. It's fun. And so I like to solve puzzles. I like to figure things out. I like to look at things and make relationships. Clearly, as an engineer, it's easy to look through data and take rudimentary basic data sets like what I just put in and make them gentle relationships between one thing and the next. Clearly, in the engineering world, the relationships we would draw were much more complex than these simple economic ones. But it's not easy. It's not hard to see this if you just piece it together. Understanding that the amount of people, you know, there's two, the in minus out is accumulation. And there's a time delay from when people get fired when they start feeling the burn. How do I know that? Well, that was my own personal experience. I think after like 3 or 4 months of not having a job, I started feeling the sweat. I was like, ooh, this is getting bad for me. So I'm not out there buying TVs and shit, like spending my money on video games or whatever when I was a kid. You kind of stop spending money. And when humans stop spending money, then that slows down the economy. As long as people have a reason to spend money, whether A, they've got a savings and not feeling the burn yet, or B, they're getting credit and living off their credit cards, or C, they're getting their jobs back like nothing happened, then people are going to keep spending the money. And if they're spending faster than people are making it, then companies will hire more people to catch up to the demand, and therefore people spend more because there's more people with jobs. And then they start raising rates because they need people so fast, or raising wages, they need people so fast. So now they're paying people more money to make the same amount of things. And therefore people are out there spending more money, which accelerates that circle, which means credit is less risky to hand out. So banks give out even better and easier credit cards to higher risk people. And therefore more people are spending money. And now that circle is going speedy mode. And you just see it like that. I don't go out there and I don't read a lot of microeconomics. I don't go out there and do anything. But if I can piece together a theory of the only thing that can cause a recession is that there's a sluggishness in the labor market and these people stay unemployed for long enough that it dries up the credit market, then the only thing I expect Powell to say is that, well, the only challenge to the current thing is the labor market. And he said that, which makes me think that I'm right. Which means that as traders, all we need to do is watch that one thing. Isn't that true? If you want to predict, is Powell going to raise rates or not raise rates? Started at the top of his motivations. It's called root cause analysis. What's the why? Powell doesn't want to create a recession and stagflation, recession with high inflation, because they're going to be the ones that have to rescue us from the depths of the crash. And it means they're going to have to buy and accumulate assets to dig us out of the hole. But they want to do quantitative tightening, which means they don't want assets on their balance sheet. They're going to let them roll off. They don't want to hold American debt and other things. They don't want to. They're getting out of that game. So they don't want to be called back in to rescue us. So they don't want to drive us into a recession by pushing too hard on the stock market, which fires everybody when stocks plummet, right? So they're holding back. They're staying chill. And as long as the labor market shows waves of unemployment, that first time unemployment, they're not going to raise rates. They're going to do nothing until those first waves of unemployment come down. And as soon as you start to see those initial jobless claims start to trend down, which means companies are in hiring sprees, while jolts are going up and first wave unemployment's going down, then they might start raising rates. So now I'm predicting when they're going to raise rates. The minute I wake up and see like 2 or 3 weeks of initial jobless claims coming down while jolts are going up, they're not going to raise rates until at least that's happening. I hope you guys follow that, right? So now I boiled the entire theory into like one thing I'm watching. So I'm going to watch every single day, every single Thursday when these numbers come out. If the initial jobless claims start trending down, which they're trending up, so we're going to set at 0 rates while that's trending up. And as long as if jolts are going up, while fewer people are getting laid off, that means companies are now hiring. which is going to stimulate the economy. They're hiring for new jobs that are created and pulling people back in. And once the economy's stimulated while the stock market's going up at the same time, then Powell can do exactly what he wants to do, which is raise rates. But at that point, the stock market won't care. We've already set the momentum in motion for growth in the economy. The stock market's going to get slapped in the face during its skyrocket up. The stock market tends to price ahead of time expectations in the global marketplace. So the stock market being so bullish right now, it looks like investors around the world believe in the economy and growth like I do, and like Rocket Scooter shows. And that it's going to be so bullish, Powell can raise rates and the stock market won't care at that point. We'll be in such a boom, it'll be a slap in the face on the way up. And that happened in the 80s. We had the same effect. Just one more before we get out of here. Make sure you guys go down to the link below. Check out Rocket Scooter if you guys want to see how the positional risk analysis that we do here. It's going to be a very... let's take out these TD bands here. Actually, let's do... let me show you more. Let's go back to here. Let's do a chart. Let's show you SPX. We had a similar effect in the 80s, and I think that this is what's going to happen here. Don't forget tonight, I'm going to be, actually I don't know when they're going to release it, probably tomorrow. I'm going to be on the Trading Camp podcast again. Excited to do that with those guys. So this will be my second time speaking on their podcast. They'll be interviewing me and talking about Rocket Scooter. So I'm excited about chit-chatting with them about what we're up to these days. Let's see how far back I can go. Right here. Similar thing. There was a recession in the 80s, early 80s. Same exact thing. And throughout 82 to 84, we had rate hikes. And the market didn't care. It jolted the market on the way up. Slapped the market in the face, but it parabolically moved. It didn't care. I think that our stock market's going to be just like this. I mean, it doesn't look any different than that right now, actually. As a matter of fact, it looks pretty much exactly like that right now. Does this look familiar, everybody? Does that look familiar? Some of y'all? Trading Camp podcast. I'll send you guys links. I don't know. I'm gonna get me some breakfast. Does this look like anything to you? Did these... hold on. Actually, let's do it like this, right? Watch this. Does this look like anything to y'all? Does this look like anything to anybody? Does this look familiar? Did these things look identical? Oh my word. Oops. Which decade are we looking at? It's the exact same things they did at the time. I'm going to make a little thing about that. This is 1982. Sorry. 1981 to 1982 recession. This year I was born. This is the... Hold on. Hold on. Oh shit, I'm an idiot. Hold on. That's funny. That's the 5-minute chart. Let me put on here. Let me go back to here. Wrong chart. How come nobody said anything? That's on a 5-minute duration. There we go. Same fucking thing though. Look, hold on. Let's go back. That's funny how it looks the same, even on the 5-minute duration. What was I right here? Let's go back to this little. There we go. I was like, it kind of looks the same, but it's still missing some pieces. Here it is, right here. Same thing. Slowly trading down, slowly trading up, slowly trading up. I'm trying to put them side by side. Sorry, Nicole came in here and was talking to me. I was distracted. When you escape a recession, it catches everyone by storm. And so when the market just wants to go bullish and all the things, you tend to have this... there we go. They look relatively identical. And that was the point of the whole outburst here. Let me... zoom in on like the part that matters, make it about the same. Oops. Just like by side for comparison. You can see the market's trading down and there's willing buyers, and then of course you had rate hikes and then rate cuts and then rate hikes into the rally. That's what I was trying to draw. That's more like it. That's a little bit better. I studied this recession to build my thesis as well. So let's put this... There we go. That's what I want to see. Not to say the past ever dictates the future, but you can see that a traditional recession typically lasts a couple years. I don't know why bears are in here thinking the recession's coming. It's coming. We already had the recession. It took place in 2 waves. Literally, COVID was a forced recession in 2020. And then 2021 and 2022, the stock market sold off. And people were getting unemployed for over a 2-year period. That's a normal breadth of a recession. The length of recession typically lasts a couple of years, and that's it. Why are we going to go into 3 and 4 legs of a recession when GDP is going up? It makes 0 sense to me. We've already been there, done that. We're in, we're out. Everyone already, if you got laid off, if you are going to get laid off, it would have happened, or else you're not getting laid off by now. Probabilistically, you're good. So, like, to me, I don't understand. I guess it's new. It's the newbiness of many traders out there. They start trading in a bear market and they think it's going to be bearish forever. Historically, in the 14 almost years I've been doing this, 13 years and growing, recessions only really last a couple years unless they're really bad, like with stagflation. Typically, recessions last a couple years and we dig out of it. We're very resilient these days. The market is very efficient to reflect what you actually see. Not that much different, right? And I'm sure right about here is exactly where everybody's like, yep, we're gonna double top and the recession's back in and we're gonna go into like 5 or 10 more years of recession. I don't understand why people feel this when all the data is pretty much there to support growing economy. So that's how I try to see things, is that I'm just trying to show you traditionally a recession lasts a couple years. Let's show the rise and fall just a little bit. Just like that. Let's try to show the, oops, the breakout high. DD's telling you all you need to know about those breakout highs, by the way. Okay. Okay. So, just general recession. A couple years, we're back out. And to me, it's very important to understand that the mechanism that would cause further recession is just not even something that's available now. I'm gonna make this chart and post it up and make every bear flip the fuck out. Ooh! I'll make people pee their pants from excitement. They're gonna be typing their rage so fast. I'm gonna go to Lisa. Why do I sound like the principal from Beavis and Butthead? Let's go here. They look, to me, they look relatively identical. I mean, you just can't. You can't. You can't not see that. Doesn't mean that that means anything. It just means that, you know, the market bled out a little bit and then it turns around and you just move. It's like recessions don't last forever. And I don't know why people think that this one's supposed to last more than 3 years. It's been 3 years. The recession started, actually, we're in year 4. So 2020, 2021, 2022. We're basically in year 4 of this weird world, right? And it's practically time to leave, right? You don't stay in recessions forever. The Great Depression lasted a decade, right? 3-4 years, 2008, we're crawling out of it. The worst economic collapse in the history of our country. After the stock market fell, within 2 years, people are back to work. How is this supposed to be any different? It makes zero sense to me why people are so bearish on this market despite changing economic data. All you want to see is the tides turn in the economy, right? We gently traded down in 2002, right? 1, 2, 3, 4, 5, you know, basically after we started selling off, started growing, we dug out. 2 or 3 years of selling off, it's pretty normal. So I just don't see the bear case anymore. Recession's over, and like before, I was right. And this is the result of the 80s, right? So once we clawed out of the recession, I mean, it's pretty good. I mean, once you get that parabolic squeeze, here's your parabola. Okay. That's when that recession ended. There's your parabola. There you go. So your parabola basically goes like that. You know, you raised up. So we had the same thing. I mean, it's bold. It's a bold move, Cotton. Who knows? We'll see if I'm right. I mean, as long as economic data grows, what's the mechanism to bring us down? If rate hikes didn't bring us down, inflation didn't bring us down, waves on unemployment didn't bring us down, What's left? These are commercials. This is not on my playlist. What else is left? That's my question. What else could happen? Only a surprise. The only thing that can bring this down would be a surprise bankruptcy of some major blue chips, banks, Walmart, McDonald's, Nike, JP Morgan, name it. Some big companies start filing bankruptcy, then that's probably bad. But I don't know anybody that's going to start filing Chapter 11 and restructuring when every stock in the entire index is growing. They've at least got free cash if they did any buybacks during the dip. So I don't know. I don't see a mechanism anymore. Just beat your pants. As long as the labor market tends to improve and GDP goes up, that's going to bake its way into the stock prices. And that's it. And you have to think of it like this. We've already entered the recession. COVID triggered massive layoffs. The natural recession that followed triggered layoffs. And we entered and we left. If you've never... The feeling... Here, think about this. This is your lesson as a trader. In a decade, you'll be here again, right? This is what it feels like to leave a recession. You've thought it was bearish for the last couple of years. Your brain is like, I'm scared to long. This is why people will say, man, I wish I would have bought that dip. I would have been such a millionaire now had I bought at the base of 2003. Because people doubt it the whole way up. The market is halfway recovered from the biggest dip we had in 3 years. And people are still doubting that it's bullish. That's why you don't go in there and throw all your money at the bottom and become a millionaire. Not saying this is going to happen, but this is the psychology of humans. This is why the stock market doesn't create hundreds of thousands of millionaires overnight because they go in and bought that Microsoft and it was worth 50 cents a share. Because as you're recovering, people debate and deny what's in front of your face. They don't go and understand the mechanics of what goes into a recession. They think that the market can crash at any moment when the commitment of traders shows liquidity, rocket scooter shows rally through October, and that all the economic data shows improvement. And that all the bad things that can happen, quantitative tightening, okay, rate hikes, high inflation, high layoffs, banks failing, did not crash this market. What the fuck else is there to crash this market? What's left that's bad that we hadn't already seen? We survived it all, baby. You got attacked by a bear, a fucking elk, an eagle came through and clawed your hair. You got run over by a truck in the middle of a forest fire, and you're still alive. What else gonna happen? An asteroid hit the planet? I don't know. War is good for the economy. You may learn anything about the baby boomers. War stimulates global economies in the long haul. My high school economics teacher, the first thing she said was, "Hi, welcome to my class. By the way, I'm going to teach you the most important thing. War is good for the economy. And I'm going to teach you all year. I'm going to spend all year teaching you why that is. Welcome to my class." This is an AP economics teacher in high school. I still remember her opening line. War is good for the economy. And in everything that I teach you, I want you to think about that. I'm going to teach you how to critically think about things. And the long haul is always good for the economy. But what's left to crash the market? Listen, I mean, we've all grown up in planet Earth. There's always World War III on the horizon. Hey, yeah. Don't you knock over my R2-D2 Lego. That took me a month to build. I have the R2-D2 Lego, the big one. Cat's over there sniffing around. Digital currency resets or something like Major in Fight Club. Essentially what happens is all the computers crash and currency goes zero. Anyways, what I'm saying is the only thing that's left is surprise bankruptcies of major companies. That's it. That's literally the only thing that's left. That's the only thing that's proven historically to crash markets that we haven't already survived. Lehman Brothers and Bear Stearns proved that surprise bankruptcies of large investment institutions can crash the market. Now, in the defense of that might not even be enough to crash the whole market because they were leveraged in the one thing that propped the market up. They were so over leveraged in the thing that crashed. So that already happened. The bankruptcies of people that were over leveraged in the thing that crashed this time around, which is called crypto, already failed. Those Silicon Valley banks are the Lehman Brothers of this decade, and they failed, and guess who was ready to gobble them right back up? Big banks jumped in, saved the day, and bought them up. They didn't have that power back in the day. Nobody wanted to buy the toxic assets of Lehman and Bear. Nobody wanted to hold that stuff. They were all shorting that stuff at that time. I think that a lot of people just weren't investing in crypto, and they're like, oh, you did that stupid thing and you crashed. Oh, well, we own you now and we're good. And then they survived. Like, the effect of a Walmart going bankrupt, would that crash the stock market? It would certainly spook the stock market, or filing for Chapter 11 would spook the stock market, but will we even survive that? How much do we need to see? Investment banks that were levered up in the thing in the bubble already popped. Okay, what's the bubble now? AI? People invested in major tech right now. If AI blows up, okay, so now the only thing that I'm looking for is if Apple or Google or Meta and these companies start filing for Chapter 11. That would be like the Lehman Brothers of the 2000s, right? So right now, I don't even think McDonald's or a Nike or a Disney or somebody going into Chapter 11 would jolt this stock market, because that's not a catastrophic snowball that proves everyone's holding that leverage, like Lehman and Bear. Proved ultimately what everybody saw was that, okay, shit, this adjustable rate mortgages and the bonds are worthless, and the housing market's going to crash, and that's going to topple everybody. Let's just hope that doesn't happen. Oh, fuck. One of them crashed. Oh, shit, another one crashed. Okay. So nobody's sitting here right now. What's the bubble that's forming? It's not real estate. It's AI. So keep your eyes on that. Major tech stocks. And McDonald's files for Chapter 11, where people are going to think, okay, well, is other fast food joints going to file for Chapter 11? It's not a systemic problem. The world isn't overly leveraged in a McDonald's or Nike or like major blue chip companies or a John Deere or something, right? So the world is kind of overly leveraging in tech right now. So here you go. Tech is your new bubble to watch. If the tech market stays strong, then I don't even think there's a case for a stock market crash under the weight of over-leveraged institutions, because tech would be the over-leveraging part. And so keep your ears peeled for your top 10 stocks on NASDAQ following Chapter 11. Your NVIDIAs, your Google's, Meta's, Apple's, fucking Pepsi's in the top 10. Like, pay attention to all your top 10 NASDAQ stocks. If they survive, we're going to survive. Cocaine Bear. Ooh, I remember that. I remember seeing that on my feed. I never watched it, though. Okay, y'all have any questions? That's my thought. Like, this is where we are. And like I said, right or wrong don't matter. But this is what people don't understand, is that you tend to deny the recession or be a recessionaholic because you start trading inside of here, and the market moves here and you're ready to be bear, and all of a sudden it jumps up again, right? And then once it jumps up, look at all the shorts that finally got squeezed, right? A whole bunch of short pressure got squeezed and they wound up buying the market over a couple of years. Don't we have the biggest short pressure wind up we've seen in decades right now? And we had rate hikes through there. Market didn't care. That's the takeaway. Fed can raise rates in the middle of a short squeeze, and people are just so upside down in their shorts that the desire of Fed rate hikes didn't even turn the market around. Let me double check. I've got those exact dates right for the rate hikes. Let's do the FOMC interest rate. Let's go that really quick. How far back we go here? Like I said, building these relationships doesn't require a degree in economics. It doesn't require anything other than you just sort of like all right, I found it. Here it is. Come on, open up. December of 1982. We went from 8.5 until August of 84 to 11.5. We actually raised rates from 8.5 to 11.5. From December of 82 till August of 84. See, this is why you join Roxy. We teach you this stuff. December of 82. Why am I using my mouse? I got my tablet. Oh yeah, I got my brand new 4K tablet. It's big. It's much bigger. It's better for my eyeballs. We raised rates from 8.5 till 11.5. Right? I guess that's okay. There it is. So people think rate hikes are bearish. I disagree. Rate hikes are neither bearish nor bullish. Rate hikes are a neutral effect. The market is what the market is. And the shorts can squeeze so hard despite raising 3% over a 1 year period, 1.5 year period. How far after 84 to the decline again? Let me get a picture of this really quick before I dump this out. This is going to be my post and all the bears go, but the rate hikes. Now again, let's go back to here. The next recession, we didn't start selling off until like 96. Let me double check. Let me brush up on my American history here. 82, 83, 84, 85. We had the Reagan era market boom until the crash, until Black Tuesday. Which everybody remembers, Black Tuesday or whatever. That was the largest to date stock market collapse, single day collapse in the history of the stock market. That was a 1 day wind up market, just fell and collapsed and continued to rally. And again, of course, the 90s. We didn't have another big problem until like the 90s, I think. Hold on, let me go back if I can remember correctly. 94. Not really even that bad. One stall year in 84. During Clinton era, you had Alan Greenspan was also raising rates, I think, in the 90s, and then had to cut rates. Well, actually, no, he was cutting rates leading into the Clintons' second run for office, and was actually cutting rates in the middle of this run. So I remember over 94, 95, there were massive rate cuts. This I do remember. So 94, 95, there's the massive rate cuts. We dropped, that's massive, but like rate cuts. You had Greenspan cutting rates up into the election to build a bull market so that Clinton can say, look at this bull market. And then right after the election, look at this, November of 1998, like, right? Started raising rates again. Market got too bullish. That the tech boom, tech boom and tech bubble of the 90s. People don't understand how powerful a tech bubble is. It's a once in a lifetime investment, AI. The reason people are very bullish tech bubble, because you remember the last tech bubble when the S&P, I don't know, went from 450 to what, 1400? 1500? People don't understand the power of stupidity of bulls. We're some dumb motherfuckers when it comes to investments. People don't understand how powerful tech bubbles can be. This is the invention of the internet, a once in a lifetime opportunity. Hello, invention of internet, this thing that's going to change the world when the S&P goes from 500 to 1500. What about large government debt all over the Western world? as long as we raise the debt ceiling and as long as we're the biggest consumer of energy products on the planet, people will still let us borrow money forever with our great credit rating because they know over time we'll always pay them back with interest. So not only do we buy everyone's products that are made from anywhere from China to Indonesia to anybody that produces oil, nobody in the world wants to see the US economy collapse. So nobody in the world is going to come calling in on their debt from us. As we stop spending, then they're in a soup kitchen for 50 years. That's the power of energy and us being the world's largest consumer of goods. That's the whole thing, is that people don't want to see the market crash. And people will let us continue to borrow money as long as we're borrowing money and then turning it into credit so we can buy stuff from them. We've always had debt. As long as we pay our debt back with interest, then we're always stimulating their economy twofold. We're paying the government back with a little bit of money, and we're buying their goods, keeping their people employed. So it's kind of like how it's always been. Markets can stay irrational longer than you can stay solvent. I love that quote, dude. Yeah. So imagine the stupidity of bulls. People don't understand what fucking tech bubbles can do. A one-time invention called the internet. Oh no. Did I delete that thing I drew? I have to redraw it. Let's go back in. I didn't mean to do that. Okay, let's just do one-time invention of the internet. Okay. Tech bubbles breed stupidity. I'm telling you guys, like, been around the block a few times. So we try to train and teach traders how to critically think here. And that's the whole point I want you guys to be aware of. All right. And tweets. Let me redraw that last one I did that I accidentally erased. Go back to 8284. Let's go. People think that FOMC cutting rates means the markets are These markets are bear. Raising rates is like bearish for the market. Like there's no relation. Market's gonna do what market does, despite that. Okay. Number 2. Let me actually get the rate hike chart on here. What is this? Interest rate decision. 82.84. Hold on, from 82 to 84. All right, let's get that guy. I'm trying to make this as pretty as I can. I like doing these things. It's fun. I'm just finding any excuse to use my new tablet. I love it. All right, let's get this chart back up here. December of 82.
See Indiana Jones and the Dial of Destiny with a free Fandango movie ticket when you spend $35.
Wait, there's a new Indiana Jones movie coming out?
Indiana Jones and the Dial of Destiny only in theaters on June 30th for limited
What the
time.
hell is it?
Participating locations, tax and gratuity excluded. Indiana Jones and the Dial of Destiny rated
Oh my
PG-13.
god. Cool. Yo, this weekend I'm going to see Millennium in Dallas. Ooh, I can't wait. Going on a little vacation. I'm leaving Thursday, by the way. No, wait, Friday. I'm going to be traveling a lot next couple of months. I'm going to Dallas. I'm going to Raleigh, North Carolina. I'm going to Chicago for Lollapalooza. I'm going to Canada for a wedding. I'll be doing a lot of traveling, but I'll still be here. People are like, where did you get your economics degree from? I'm like, man, I'm probably the most stupid person when it comes to economics, but I can build relationships better than anyone else, I bet. Putting stuff together ain't hard to do. I love making my little Babe Ruth swing for the fence. The recession might be over for multiple reasons. Here's number 1. Creating jobs. Okay, here's number 2. GDP. Creating jobs. People going back to work, etc., etc., etc. In reality, like, how did I know how to do this? Nobody taught me how to do this. I'm teaching you how to do this. Just by spending years looking at charts. Like, that's what I was kind of designed to do in my former career, is I just liked looking at charts and looking at data. And data has to make sense to me. As an engineer, you're trained to figure anything out. That's the best part about doing that for a living. Engineering, if you're good at engineering, you can figure anything out. Like, that's the whole point. Like, I've started so many different companies over the course of my life. I've built a trading platform. I've written 2 novels, actually, believe it or not. I don't even talk about that. You can do anything if you know how to do, if you learn how to do anything. And it's like what my job was designed as a young engineer. They teach you how to figure anything out. Whatever you want to accomplish, here are steps you can do to solve it. Why is this not going all the way to the left? There we go. Your job is how to be good at anything, how to solve problems. Well, anything you can train yourself how to do and solve the problems that come with that. That's the whole... I could do 4 charts. Damn it, I forgot one. That's okay, we'll put both of them together. One more, I'm missing one more. Let's go shake up the world of the bears. Let's go make them full of anger and rage. All right. Let's get everybody talking today. Am I missing a tab? Oh, there it is. Oh, there we go. Let's put like, let's do it in quads. Okay. That'll work. Let's get the bears talking. Let's shake it up, as Taylor Swift would say. Oh, we need to make these skinnier. I'm gonna get these on quadrants. Wish I can close this nonsense over there. Let me just write the title on this one. Let's put the waves of layoffs. Oh, stop. Windows arrow. Go away. Nobody likes you. That'll work. I'm gonna come in clutch. I'm gonna talk about this, and I've also been preparing this for tonight's podcast. I'm gonna talk the same stuff. There you folks have it. Matt Coward from Rocket Scooter, biggest bull on the planet right now. Thank you. So Mail and Trading Camp podcast should be releasing, probably drop it tonight or tomorrow. So let's talk about the 4 major things to talk about today. I'm gonna call it quits. Make sure you go sign up for the Rocket Scooter extended trial. You can play at the platform, get all the positional risk data we have here. But in the meantime, sit here and watch me play on my new tablet. I love it. I'm gonna change that. Okay. 4 waves of unemployment. 1, 2, 3, 4. 4 waves of layoffs. Wave 4. Worst one, right? But 1, 2. Just starting. I need a different color than green. Whatever. They can deal. Oh, put a little bearish. Maybe some more that. Oh, I like the unemployment findings. I mean, you must have been previously unemployed. These aren't the people that didn't file for unemployment that are like not getting benefits or whatever. There's people that were working and they filed unemployment because they qualified for it. Let's go. All right, I'm done. Love you guys. I'm out. I'm out. Go to Rock Scooter. We'll see y'all later. Oh, I got a Wacom. I used to have a Wacom. I had a 13-inch, and it was 1080p, and it was small, and it didn't work with my 2K monitors very well. It was always real glitchy. And then finally, my cat knocked it off the stand, and it fucking button broke, and the case snapped. I snapped it back together, but it's still kind of wonky, and it didn't work too well. And I was like, it's time to get a new one. So I went up and got the 16-inch Cintiq Pro. And it's great because it's actually a 4K resolution. It's really nice. So it basically mirrors this screen, and also it's USB-C. The 13 Pro Cintiq Pro was you had to have like, it didn't do Thunderbolt connections, so I had to do 2 plugs. I had to use an HDMI for my graphics card, which is what made it all glitch out because I had different refresh rates running. Even a 3080 Ti didn't like that. And I had to use, you know, obviously USB for the touchscreen feature. Now, I have a Thunderbolt, since I have 2 CPUs in the same box, or two motherboards in the same box. I have a Thunderbolt cable straight from the motherboard with the one chip that has onboard graphics powering the monitor. So the touchscreen is being powered by the onboard graphics of the CPU, completely independent than my 2 graphics cards, which are powering my other 7 monitors. So it's nice. So my tablet is completely independent from my GPU. So like you see when I play games, the tablet would like lower my refresh rate. I'd, like games would be at like 70 frames a second. It would all get all glitchy and weird. But now it's good. So Econ 101 tried to quantify human behavior, which is insane when you think about it. It certainly is, right? So you start watching your streams every day, you slowly start learning this more and more. Luigi, since I started streaming, I'm learning this more and more. The more you explore and the more you dive and the more you play, the better you get. Nobody out there has all the answers. What you need to do is find out what works for you and the way you understand and see the world around you. That's the whole point of existence to begin with. We're all computers, either accidentally here or designed to be here to experience the world. Without us being here, that old age-old thing, if a tree falls in the forest and you weren't around, would it make a sound? The absolute answer is no. The quantum world we live in doesn't collapse into observable molecules and observable things unless there's something here to observe it. We proved that. A photon from the double slit experiment that you observe right now that traveled here from 13 billion years collapsed into a photon the moment you observed it through that experience, which adapts how it traveled to you through time. As a matter of fact, the double slit experiment proves that we can look at light from the edge of the universe, and then we can alter what it did 13 billion years ago and turn it to a molecule even back then, or a photon even back then in time. We can send information back in time through that quantum uncertainty, and therefore it proves that this universe doesn't exist without us being here to observe it. Neither does time. Fantastic things. And you just learn through exploring. Exploring is the best thing you can ever do. And the more you play with something, the more you understand it. So keep exploring, friends. Put on your Indiana Jones hats. Keep going. Love y'all. Thanks for tuning in. Make sure you head over. Oops. Oh, you can see my Discord here. When did I click the wrong button? Y'all see the liquidity map. You should keep on heading over to head over to the Discord, by the way. On that note, let me get out of here. And now we'll see y'all later. Love y'all to death. We'll have a trade review. Yeah, I do Zoom calls every day. We'll do a Zoom call today. We'll see y'all then. Come on over. Make sure you sign up for the Rock Scooter Extended Trial. We love y'all to death. And thanks for supporting the community and the group and the platform. See y'all later.